Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. The stock market world has been quite mystified by the disappearance of Dr. Michael Burry, a famous American investor and a hedge fund manager. Before the vanishing of Burry on Twitter in mid-March, he left clues and cautions about the incoming out-of-control inflation, the widespread predictions and exorbitant valuations on the financial markets that might be heading for a fall. In February, he emphasized that the stock market was dancing on a knife's edge and lambasted stock trading software Robinhood as a deadly casino. But it wasn't until his apocalyptic predictions about impending inflation. In that time, the officials began to be alarmed. Burry was allegedly visited by Securities and Exchange Commission officials who warned him about his Twitter activity and how it could be influencing the markets. According to numerous sources, his final tweets on Twitter before being gone in the wind are fascinating and very interesting, since it could provide insight into the thoughts of a man who is well known for predicting severe financial downturns. And yes, he deleted his profile after the tweets have gotten him into trouble with some investors. Let's dive in and go into detail about these terrifying tweets that reveal an unsettling fact about America's future and growing economy. In today's video, we will all examine it. Can we skip to the good part? Maybe no. It wasn't a good story though. The narrative begins on February 20th, 2021, with a tweet linked to a book titled The Dying of Money, in which Burry claims that the US government is encouraging inflation with their new lunatic monetary strategy. The unprecedented effect of the pandemic put the US Federal Reserve on a printing frenzy out of nowhere, producing more money in the last 13 months than at any other time in US history, with 3 stimulus checks paid out to ordinary Americans and a 4th on the way. The involvement of this money-printing consequences are beginning to be felt. This, along with a sluggish demand and a rising debt-to-GDP ratio, thus resulted in an unhealthily American economy. Things might appear to be fine right now, but if you dig and know your past, you can see what's lurking behind the surface. Despite the fact that everything we're seeing right now leads to a catastrophic inflation crisis, the administration claims inflation is still under 2%. It's funny how they deny it and keep pretending like things are normal. Try to look around and see the effects of what they're trying to falsely claim. There are price hikes in the process of petroleum, cars, houses, groceries, and many more. Name it all, and you have all been witness to the significant price rises in the last year alone. The Fed chair, on the other hand, argues it's only temporary, repeating this term over and over again in the minds of all listeners. Those deafening repeated words or statements have been burned into their minds and ears. And how much inflation is the Federal Reserve willing to endure before intervening to keep pricing pressures in check? Powell stated that talking about inflation, there are a couple of points worth noting. One is that they measure inflation on a trailing 12-month basis, and as they get past the very low inflation readings of March and April of last year, they'll see 12-month inflation rise up a few tenths. This is simply referred to as base effects, and it is a temporary phenomenon that they believe will pass. There's also the possibility, and some estimates suggest, that once the economy completely reopens, there will be a surge of spending because people will be relieved that the pandemic is gone. People are more excited to go and spend a lot outside of their homes after a long quarantine and lockdown period. This might put up upward pressure on inflation right now. Again, they regard that as something that is likely to be temporary and not very substantial in both circumstances. They don't see those as very large or permanent. Things are going to become quite obvious at some point. The Fed chair will be compelled to reorganize and admit inflation, and the consequences will be set in motion. The ultimate spiral, which leads us to the second Burry tweet of the day. The real highlights of this video, and here it is. A tweet that serves as a reminder that the inflation cycle does not happen all at once. Germany has lasted 9 years, with the last year being a full collapse. This graph helps put that tweet into context. From 1918 to 1923, this was the value of 1 ounce of gold in relation to 1 German mark. For years, the German mark has been subjected to severe inflation. Remember that this graph is in log scale, so it won't move up in even numbers on the right y-axis. Instead, it'll go up exponentially. By 1923, the German mark was worthless and had collapsed to the point that it could be used as toilet paper. Funny as it may be described, but it is real. Also keep in mind that the build-up lasted a year. While 1923 may seem like a long time ago in our imaginations and seems to be unbelievable, the United States is not immune to this situation, as bizarre as it may seem. Hyperinflation is well acknowledged as the most common method of bringing down a country, and this one is no different. We've laid the groundwork based on last year's events. All that is needed now is a catalyst to bring it down. And what could be the catalyst? What could be some of the ways to hedge against inflation? Burry is well aware that the current round of generous currency printing is pushing money into stock markets. On February 21st, he tweeted out his final tweet, stating that professional investment teams are increasingly taking more and bigger risks by getting innovative in order to build leveraged positions. It's like he already predicted what would happen, because this growing story is generating rippling effects through the markets, and yes, we are witnessing it. The collapse of Archegos Capital Management, a family firm that has built large investments in media companies and Chinese internet brands, made it on headlines. When some of those views shifted against it, as we saw last week, we briefly discussed why that was the case. Bill Wang, the founder of Archegos firm, which was set up as a family office after his own was closed, was a part of Tiger Asia. He's a protege disciple, and he was compelled to liquidate more than $20 billion in stocks at the core of all this. He lost that huge amount of investment, the losses tied to the collapse of the Archegos. In 2012, on behalf of Tiger Asia, he pleaded guilty to wire fraud, and now it all seemed to come crashing down late last week when Goldman Sachs, which had previously refused to do business with Bill Wang because of all those insider trading allegations, pushed him to sell some of the stocks he had been long and leveraged long in a big way, especially technology stocks like Viacom and Baidu. Now, as we saw last week, Viacom was hit very hard in part that it issued the stock midweek. Archegos Capital would implode 1 month later in the middle of a bull market, a condition in which prices are rising or prices expected to rise. Archegos is a firm that managed over $10 billion in capital, and according to reports, losses may have topped $50 billion due to extreme leverage. If you read into the details, you can quickly see that this problem was created by complicated financial engineering, and Bill Wang was ultimately the biggest investing loser.
Loser! You're a loser! Are you feeling sorry for yourself?
Archegos was able to build enormous investments because its positions were derivatives rather than actual stocks. Some of them gave it access to more than 10% of these companies' stock without having to report their holdings to regulators. They would have had to do something similar with conventional stock investments of that size. This allowed Archegos to keep its exposure to those stocks hidden until the deals blew out. The downfall of Archegos is yet another example of how much debt has been built up during this market craze, as well as how sensitive investment banks are to it. If the economy is doing well and large investment banks are losing billions of dollars and going bankrupt, what will happen if the economy takes a sharp and unexpected turn? The Archegos story was forgotten in a single day, yet it is a valuable lesson and an event that should be investigated further. If a competent investing team can lose $50 billion during a large bull market, imagine what's lurking beneath the surface, waiting to wreck the entire market when things go wrong. Massive derivative positions are currently being constructed, and the catalyst I said before is right in front of our eyes. We know we should just act on it. How long will it be until the house of cards collapses? So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.